I think gold's going to move in the year 2000. Since 2000, gold has moved from $253 an ounce to a high of 27 something, currently around 26. What is that, a sevenfold return? Gold has done 8 and change compounded annually for 24 years. And some moron says, when is gold going to move? It always fails. That person is innumerate. Mercifully for me, people who are probably smarter than me that don't apply their brains to the task at hand lose money while I make money.
The U.S. dollar has long held a dominant position in global finance. However, this supremacy is increasingly being challenged by countries around the world. A growing number of nations are actively working to reduce the influence of the U.S. dollar on international trade by pursuing de-dollarization strategies. This shift includes the creation of alternative global financial and technical systems. Reports indicate that the dollar's status as a reserve currency is declining faster than commonly understood. In the past year, the global share of U.S. dollar reserves fell at a rate 10 times higher than the average decline over the previous 2 decades. Currently, around 12 countries are actively moving away from reliance on the U.S. dollar. On the other side, Rick Rule mentioned that since the year 2000, gold has risen from $253 an ounce to a high of $2,700 and currently sits at around $2,600. This marks a sevenfold increase. Over the past 24 years, gold has delivered an average annual compounded return of over 8%. He believes that gold is set to continue this upward trend. Gold continues to surge, and rising debt levels in the U.S., along with elevated yields, are expected to support a bullish outlook for the precious metal. Over the past 6 to 9 months, according to the World Gold Council, when investors were asked about their reasons for buying gold, concerns about debt have increasingly come to the forefront. While inflation and geopolitical risks were previously the main drivers, the threat of a potential debt crisis, stemming from excessive debt burdens on economies, has become a significant factor in gold's appeal. Rick Rule suggests that history supports the strategy of governments choosing to default gradually by inflating away the purchasing power of their obligations rather than outright defaulting. In his view, this approach creates a favorable environment for gold, as inflation tends to erode the value of currencies while increasing the appeal of tangible assets like gold. Before we jump into more content, consider subscribing and enabling notifications to stay updated with our latest uploads.
The on-balance sheet liabilities of the U.S. government are $36 trillion. The off-balance sheet liabilities are estimated to be $100 trillion. You add those two numbers together and you subtract the Fed's balance sheet, and it means that the recourse liabilities to the United States government exceed $130 trillion. The Internal Revenue Service suggests that the net private wealth in the United States is $141 trillion. $141 trillion, which is what we're worth privately, subtracting $130 trillion, which is what we owe collectively, is not pretty arithmetic. Looked at it differently, or perhaps the same way, the increase in the liabilities, both on balance sheet and off balance sheet, appears to be about $4 or $5 trillion per year. That isn't just the on-balance sheet deficit. It includes accretion of unfunded liabilities like Medicare, Medicaid, and Social Security. The gross federal revenues before any expenditures are that same number, which is to say the deficit increases by the amount of gross federal revenue that we have. This debt is unsustainable, and dealing with the debt is politically unfeasible. Now, we dealt with this as a people before, although the problem was less severe. In the decade of the 1970s, politically, we couldn't raise taxes, but we had to pay for deficits, and we had to account for the debt brought up in the war in Vietnam, which of course we lost, and the war on poverty, which of course we lost. How did we do that? Well, in the decade of the 70s, according to the U.S. government, through inflation, we reduced the purchasing power of the U.S. dollar by 75% over 10 years. Not coincidentally, the gold price went from $35 to $850. The only way that we can service the nominal debt that we have as a people, particularly our entitlements obligation, is to inflate away the net present value of the obligation while leaving the nominal value intact. I don't know what Social Security pays me, but let's say it's $4,000. I was a high income taxpayer. 10 years from now, they'll still pay me that nominal amount. They won't reduce it, although they can't afford to pay it. What they will do is they will inflate away the net present value of that nominal account. So my $4,000 will buy me $600 or $700, maybe $1,000 worth of goods and services. That's how you deal with that sort of thing. You either default honestly, you say to the bondholders and you say to the entitlement holders, too bad, so sad, money's all gone, strong letter to follow, or you default gradually. by inflating away the net present value of the purchasing power. My suspicion is past is prologue, and we take door B, which is very good for gold. Gold in 2024, who knows? Gold in 2025, who knows? Look over 10 years. If you look back to the decade of the 70s, it'll tell you something about the trajectory. 1970 to 1972, gold went from being controlled to decontrolled, so it was $35 to $100. 74, gold went on a tear from $100 to $200, doubled. 1975, the Fed raised the interest rates. Gold fell from 200 to 100. End of 1975, the Fed lost their nerve politically, cut the interest rates. And that set off a romp at the end of 1975 that saw gold go to $850. Past in this case is prologue. Gold will go up and down, higher bottoms, higher tops. People who don't understand the process will be shaken out when gold softens up.
Speculation remains high over whether silver could experience a breakout rally similar to gold's impressive rise this year, with many eyeing potential gains for pure-play silver mining stocks. In 2024, silver has shown consistent upward momentum, breaking out of its historical trading range of $18 to $22. By mid-October, the silver price had climbed to $34 per ounce, sparking renewed optimism among silver bulls. Many are now setting their sights on the peaks silver reached back in 2010, hoping for a similar rally. Reflecting on a recent silver trade, Rick Rule mentions that he didn't have a clear prediction on where silver prices would go, but he saw a promising opportunity in a highly volatile market where all the sellers had already been exhausted. For Rule, this was a strong indication that prices were poised to rise, needing only a small amount of buying pressure to drive them up. Just 9 months later, silver prices had surged by 300%, and at events like Beaver Creek, companies are now receiving offers of $60 million, a significant increase from the previous $7 million for the same investment narrative. Let's now turn our attention to the video again.
The US dollar is the worst currency in the world, as Doug Casey would say, except all the others. Doug is. Have you ever interviewed Doug, by the way?
Just last week or 10 days ago. Yeah.
I mean, he's just great. He's the best. Alarmist, but he's better at narrative than I, so he's more fun to interview. Let's get back to your question. Doug described the US dollar as an IOU nothing. He described the euro, which has, 15, 16 countries, as a who owes you nothing. And I would suggest that the BRICS, a bunch of countries with inconvertible currencies who don't like or trust each other, is a nobody owes you anything. So in that league, the US dollar is pretty strong. I save and insure in gold. I maintain my liquidity in US dollars. And I invest in companies. That's sort of how I look at it. I have a lot of US dollars right now because I have more liquidity than I would like to have, which is really a consequence of the fact that I'm like Buffett, sadly to a different degree, opportunity constrained. When you go into a silver bull market, you won't be concerned about dollar moves or dollar and a half moves. And you won't need some old crank named Rick Rule to tell you when you have a silver market, and by the way, it's when, the market will be absolutely positively dramatic. And if you aren't prepared for it, maybe early, maybe 2 years early, the best part of the move, you'll lose. When I look back to my recent silver junior trade, I had no idea where the silver price was going to go. I just knew that you had a sector that was extraordinarily volatile, that had no sellers left. The predominance of questions that were asked of me were despondent about the silver market. All of the social media discussion was despondent about the silver market. High quality silver issuers, juniors, weren't getting funded, which is to say the momentum was terrible. Well, of course the price is going to go up. If all the sellers have been exhausted, it doesn't take much of a buyer to drive the price. Now, 9 months later, the prices are up 300%. Guys go tell the same story at Beaver Creek that they told last year, and as opposed to taking 7, they're offered 60.
It is increasingly clear that the dominance of the US dollar is facing challenges. Trust in the dollar's stability may erode due to rising national debt, deep political divisions, and the frequent use of sanctions as a geopolitical tool. As a result, many investors are turning to gold to mitigate risks associated with other assets like stocks and real estate. Gold has a long-standing reputation as a safeguard against economic downturns, providing stability during periods of financial uncertainty. Do you agree that gold is still a reliable hedge against financial instability? We want to hear from you. Feel free to leave your thoughts in the comments, give a thumbs up if you liked what you saw, and subscribe to stay connected with our ongoing exploration.